we're going to go over the same idea. Let's say you're getting conventional financing, you have a good credit score of over 700, say we're going to assume around 740, and you have a monthly income, a yearly income of $75,000. How much home can you get? Okay, let's get into it. And before we get into the numbers, I'm going to give you a couple of disclaimers. The first disclaimer is this video is not meant to pre-approve you. That's not what this is about. And so, I'm going to throw numbers that, with this much income, monthly income, you can go and get this much house roughly. But don't take this to the bank, or don't think, this is hard data that's good for you, because what you need to do is go talk to a lender. And if you don't know any lenders, hey, check out the links below. I contain links to how you can get in touch with me, and I can put you in touch with some good lenders. So I'm happy to do that. I don't make any money out of doing that. This is all for your educational purposes only. And saying that, the idea of this video is just to give you a ballpark idea estimate of, I make $75,000 a year, and that means I can roughly get around this much home is how much I can buy. That's all this video is intended, but for your educational purposes, that can be very useful. Okay, so that's the first disclaimer. I'm not a mortgage specialist. You need to talk to someone who is. And secondly, I do have a bunch of figures written down on a pad in front of me, so I will be glancing down at that quite a little bit in this video. Okay, so let's get into it. As I went over in the last video, the first thing to talk about when you're talking about yearly income is figuring out how much home you can get. You first need, what you do is break it down into monthly income. So $75,000 breaks down to about $6,200 a month. So out of that $6,200 a month, how much of that can you put towards a mortgage? Well, they call it a debt-to-income ratio. When you go talk to a lender, the first thing they're going to do once they see your monthly income is then also going to want to know, what are your debts every month? Now, some people have no debts, and by debts we mean things like car payments, credit card, balances, not the balance, but, let's say you have a monthly credit card balance of $50, you have a car payment for $300, and you have a student loan for $100. That's one scenario we're going to use in this video. That would total $450 a month of monthly debt that you're paying every month. The other scenario we're going to use is where you have no debts. You don't have a car payment, you might have paid off your car, and you might pay off your credit card balance every month, and maybe you don't have any student loans. So you don't have any monthly debt that you're servicing. That gives you very different amounts of home you can buy, which you'll see in this video as we go over the numbers. The next thing, the credit score is really important, because a good credit score means lower interest rates, and lower interest rate on your mortgage means you can buy more home. When you have a lower credit score, you get charged a higher interest rate, which means the amount of money you have available to pay your mortgage, less is going to actually pay for the house, and more is going to pay for the interest that's going to the bank. So I hope that all makes sense. If it doesn't, check out the link above. I go over some of that in the video right there. Okay, so let's get back to it. $75,000 of annual income breaks down to $6,200 a month available. That's your monthly income. Let's assume firstly you have no debts. So in a conventional financing, let's say, most conventional financings, that they let you use 45% of your monthly income as a mortgage. And they call it the debt-to-income ratio. So 45% of your monthly income, which is $6,200, is $2,810 a month. So, the main difference here between when you're having like debt at $450 a month and you don't, it means that $2,810 a month, when you have no debts, you can use the full amount of that towards your mortgage. But if you have $450 of debt, or whatever amount it is, $1,500 or $600, whatever it is, you have to subtract that debt from that monthly income, that 45%. So in this example, $6,200 is your monthly income. You can use a maximum of 45% of that towards your mortgage. That's called the debt-to-income ratio in conventional financing. That breaks down to $2,810 a month. But if you have, let's say in the example where we have $450 of debt, you now have to take that $450 off that $2,810, which would give you a monthly income of $2,360. So you've got less money that can go towards the mortgage because you have to first of all pay off that $450 in debt. So that's how that works. Okay, so let's go through some numbers. We're going to go 3% down, 5% down, and 10% down. Okay, so 3% down using $2,810 a month, which is the maximum amount you can use for your mortgage, with a $75,000 annual income. We're using an interest rate of 6.25% for 3% down. That's going to get you $370,000 of home. $370,000. Okay, and then what about when you have the $450 debt? Now the maximum amount of monthly income you can put towards a mortgage is $2,360, remember? So in that case, you can get $305,000 of house. That's a big difference. That's $65,000 difference between having zero debt and $450 a month of debt. So you can see that really affects how much home you can afford in a big way. Okay, so that's the first one. Let's go to 5% down. If you're putting 5% down as a down payment, you have zero debt, so you can use the full $2,810 a month towards your mortgage. That's going to get you around $385,000 of home. Now, going back to the other side, when you have the $450 a month of debt, which means you can put the $2,360 towards your mortgage, that gets you $325,000 of home. That's $60,000 difference there. $385,000 with no debt, $325,000 with the $450 a month debt. And then what about the 10% down? 10% down with zero debt, which means you can again use the full $2,810 a month towards your mortgage. That gets you $410,000 of home. And that's with an interest rate of 6.125% and 10% down. Now we go again to let's say you have $450 of debt a month and you're putting 10% down. So now again, you only have $2,360 a month available towards the mortgage. That gets you $345,000 of home. Okay, so let's just run over that really quickly again. $75,000 is your annual income. That breaks down to $6,200 a month. With a conventional financing, they're going to let you go up to, say, a maximum maybe of 45% of that $6,200 a month as money you can use towards your mortgage. So let's go in this scenario where you have zero debt. You don't have any debts every month, so 3% down gets you $370,000 of home. 5% down gets you $385,000 of home. And 10% down payment will get you $410,000 of home. Now we go again to when you do have a monthly debt of around $450 a month. 3% down gets you $305,000 of home. 5% down gets you $325,000 of home. And 10% down gets you $345,000 of home. So now look at in the $75,000 income bracket. We've looked at if you put 3% down, 5% down, and 10% down, what about 20% down? Because the 20% down is an interesting level. First of all, you're putting more money down, so it means you can afford more home. But also, you no longer have to pay PMI, private mortgage insurance. Okay, so what about 20% down? 20% down, you can buy a $480,000 home. Wow, that's a big difference. 3% down, $370,000. 20% down, $480,000. That's a $110,000 difference with exactly the same income, just because you're putting more down. So, like I said in the previous video on the same subject, if you let's use an example of a $100,000 home, putting 3% down, what's that? $3,000. So you still owe $97,000 balance on the loan. You put 20% down, that's $20,000. Now you only owe $80,000. And so, what's the difference between paying, $80,000 back and $97,000? Well, if you max out your mortgage payment on both loan amounts, what it means is you can afford more home when you put more down. And you don't have the private mortgage insurance. 20%, once you get to 20% down, you no longer need to pay private mortgage insurance, which in this case, in the 3% down was $250. You're saving yourself $250 a month that you no longer need to pay by putting 20% down a month. So you can put an extra $250 a month into your mortgage payment, which buys you more home. Part of the reason why you can now get $480,000 of home with a $75,000 income by putting 20% down when you have no debt. When you put 3% down, you can only get $370,000. So just think about that. That's really something. Okay, now let's go also to the other side where we assumed you do have monthly debt of around $450 a month. 20% down, what does that get you? 20% down gets you around an even $400,000 of home. So again, when you put 3% down with $450 a month debt, you were getting about $305,000. And now 20% down, you're not putting the private mortgage insurance. So you're saving about $200 a month in private mortgage insurance. When you put 3% down, your private mortgage insurance was just over $300. That $300 can now go into your mortgage, which means you can buy more home. Not only that, but also putting 20% down means the loan amount is less that you have to pay back. So there it is. Think about that. $75,000 income. When you have the $450 a month debt, you can either get $305,000 of home with putting 3% down, or if you save and can put 20% down, you get up to $400,000. And then again, once again, if you do not have any monthly debt, $75,000 income, you put 3% down, you can get $370,000 of home. But you put 20% down, you can get $480,000 of home. Wow, that's really amazing. So you can see, I hope you've seen in this video that the question, well, how much home can my $75,000 income get me? There's no one simple answer. It depends how much you're putting down really affects it. What's your credit score really affects it. What's your debt to income ratio? These are all the factors. It's kind of like a jigsaw puzzle, and when you put them all together, you get the answer. But you can see, from this video, I hope you're going to get a general feel from, the price range, but still, we're talking about over $100,000 of difference in home prices between, with exactly the same income, just determined by I'm putting a different amount down or I have a different amount of debt. And we haven't even talked about your credit score. We're assuming that you have a good credit score. When you have a bad credit score, you're going to be able to afford less home because you're going to have a higher interest rate. Okay, hope that's been helpful. Again, this is just for your education. This is not in any way meant to be used as, oh, that means I'm pre-qualified for $410,000, I can start looking. No, it doesn't mean that at all. You have to go speak to a lender. Your situation is going to be individual to yourself in terms of your debts, in terms of your income, in terms of your credit score, and in all those things are going to affect the numbers that the bank's going to give you of how much home they're going to pre-approve you for. So I hope that's been useful to you. And, again, check the links below. I do have, referrals to lenders if you want to speak to a lender. I do go over these figures in the description, so you can check them out there. I know it's a lot of numbers. It'll make more sense maybe to you there. And finally, hey, if you found any of the information useful, hey, smash that like button. Hit the subscribe button to stay tuned for more videos. And I really appreciate you watching, and thanks for watching.